Trader Strategies market commentary for Tuesday, July the 10th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies you can implement into your portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios, and therefore what I'm doing could be counterintuitive to what you are already doing. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having all that out of the way, let's get it on with some economic data. It's not the most important economic data we generally receive throughout the month, but I want to talk about some of these because they are not looking too great across the pond. We got French industrial production came in at negative 0.2%, expected to be a positive 0.5 or 0.7%. Italian industrial production came in at 0.7%, expected to be a 0.9%, and they revised last month's number down to from negative 1.2% to negative 1.3%, so not much of a revision there. Great Britain manufacturing production came in at 0.4%, expected to be 1%, and then they did revise last month's number up 0.1%. So still not a very good number there. Then we look at Great Britain construction output. This is a silver lining, I guess, if you will. Came in at 2.9%, expected to be 0.4%, so knocking it out of the park there. But then we flip back to industrial production again out of Great Britain, and it came in at negative 0.4%, expected to be a positive 0.5%, and they revised last month's number down 0.2%. So those numbers aren't looking too great right now. The ZEW economic sentiment came in at negative 18.7% for Europe, expected to be at negative 13.2%, so much worse than expected there. Economic sentiment out of Great Britain, negative 24.7, expected to be a negative 17.9. So don't really look at those, but those are some pretty major misses, and that's the reason why I wanted to talk about those with you guys. We also got the NFIB, which is National Federation of Independent Businesses Small Business Index, and what that is a survey of small businesses, less than 150 employees, asking them about what they feel about the market in general, the economic outlook, and hiring going forward. It came in higher than expected at 107.2, expected to be 105.5, so better on that end. All right, and then we also got JOLTS job openings, which isn't a huge number, but it's something to look at anyway. It's 6.64 million job openings, expected to be 6.85 million job openings, so less than expected there, but they revised last month's number up, so it all kind of washes out. But those job openings could start thinning out as we approach full employment, so keep that in mind as well. Crude oil moving higher by about 19 cents right now. Tested the 78 Fibonacci extension level early this morning. All of this is basically on, I said Iraq yesterday, it's on Iran talking about cutting their production. Remember, we've been dealing without Iran in OPEC for 10, 20 years, and now all of a sudden they say they're going to shut off the spigots. It's not that much a day coming out of Iran, you guys, that's going to really affect us, aside from the fact that they're still probably funneling oil to China, even if they say they're cutting production. So it's not happening. All right, gold coming off by about $4.50. You know, there's a flight to safety idea in there for a little bit. And that being said, sorry, one of my sticky notes came out in front of you guys. That being said, just not a whole lot of room to the upside, similar to that of bonds. We talked about this a couple of days. Bonds are overextended to the upside with the Fed mandate of increasing interest rates. The economic data here in at least the United States being pretty good. That would imply that Fed is going to continue raising rates. I think they're going to maybe do it one more time this year, but I think they should slow down just to make sure that everything is in order, if you will. But bonds coming off a little bit today, helping my TLT trade. Then we've got the VIX. You know, after a few days of really selling off, we're starting to find a little bit of bottom here, and that is despite the fact that we're seeing the equities move higher, which leads one to believe, is there some a lot of put buying going on in the options in order to drive that VIX up, even though we are continuing to rally. That would be people a little bit fearful of the downside. So, but the Dow Jones Industrial Average up over 140 some odd points and popped above this 23 Fibonacci. I thought we were going to kind of settle down here. I don't know that we're out of the woods there, but one thing we did mention yesterday in the market commentary was that this 23 Fibonacci level may not act as much of a support and resistance as one would expect with a Fibonacci level, because it lines up perfectly with the point of control where the most time and volume has been spent. That's going to kind of negate that support and resistance a little bit as the market kind of pounds back and forth at those levels that the market's comfortable. All right, NASDAQ moving higher. One thing to note, if we finish like this, that doesn't look too good. And I'm going to show you guys something here in a little bit on IWM that kind of reflects this as well. But we got above the 50 yesterday, as we talked about. But today it's kind of dying out a little bit, not getting nearly the movement that we would expect. The tech sector's been, lagging in a sense and kind of caught up, so we might start seeing some profit taking going on in the tech sector. E-mini S&Ps kind of sandwiched right between the 78 Fibonacci extension and this value area high. Value area high is probably not going to act as much as a resistance here. It's really the target is the 78, which I've talked about many times. That's that psychological level of 7,800. That corresponds with the 78 Fibonacci extension. So that is going to be a major hurdle, not only psychologically but technically. This is the E-mini S&Ps on the 30-minute chart. As you can see, overnight inventory was getting short. They flushed them out a little bit on the economic data. They tried to decide what to do, and lo and behold, we started moving higher as the overall market seems very bullish right now. Here, let me talk about, before I talk about my trades, I want to talk about, let's just take a look at IWM. Yesterday was kind of setting up. Not looking like that today. Look almost like a continuation pattern. But today, when I saw it was in negative territory, it looked like it might be trying to confirm a little bit of a top here. But with this market movement today, to me, almost looks like more of a continuation pattern to go up and test the 170 high there. All right, but I wanted to look at that because it wasn't looking too great this morning. All right, Yum Brands. This is a trade that I ended up covering, you guys, because I talked about it yesterday. I was playing around with it, letting it work out a little bit. Today, we're starting to get this little bit of a top here, so I wanted to get out of this trade. And in Yum Brands, I had on the July, I was short the 75 puts. As you can see, they were never really even tested necessarily, but I caught it on that bottom thinking there was going to be somewhat of a bounce. I got that move, and we are moving higher now, so that theta decay all coming out of those July, because there's only a couple of days left, 11 days, 10 days left. So a lot of theta decay. We show that on those charts in those daily market in the webinars. I have that chart that shows that theta decay happening, and it really starts ramping up. I don't want to play around with it in the last 10 days where we start really seeing that come off for a dime. So in Yum Brands, I went in there and sold those July 75 puts in there for 48 cents. I bought them back for 12 cents, right? There's no sense in holding on to this trade for another 10 days to try and get that other 10 cents. It doesn't make sense. The risk reward is not there, you guys. Just pull the ripcord on it. Get out. I squeezed that for over 50% of my profit, but that was because I was getting that real nice market movement, got above this Fibonacci, so I decided to let it ride out and play out a little bit longer. So that was the catalyst for that one. And then on to Deere, which is another trade that I got out of. I didn't expect it to really start topping out here, but having said that, I ended up going in to get out of this trade. Hold on a second. So with Deere, I went into the July, sold the 125 puts in there originally for 75 cents, bought those back for 10 cents. Now over in my IRA, I did that same trade, but I had the defined risk. So I was short the 125 puts, defined it by buying the 105 puts, and did those, the 105 puts, basically for a penny, couple of pennies. So to define that risk, I think I paid 2 cents for it. So I did that whole strategy for about 73 cents in there for the IRA. All right, so out of both deer in my IRA, and my margin account got out of Yum Brands, which I only had in my margin account. All right, this is one that I added today. Topping pattern here. Anytime you get this doji, it's almost a shooting star at the top of this move. That is a very bullish signal. I was looking at this to come down and hopefully confirm it. It needs to really get below 202 to really make a confirmation of a top here. I got in a little bit early, as I usually do, and I went in and sold the July because I'm in early. Not a whole lot of days left. We have earnings in this next month. High implied volatility. I think we're going to get a little bit of a rollover. This is more of a gamma trade because it's inside that last 10 days. I'm trying to get close to the top there. I've basically sold the 207.5 calls in there. So I'm getting really tight. It's a real gamma trade. We get much of a movement to the downside, I'll be able to see that decay happen rather quickly through gamma and delta. So if I get like a couple dollar moves down, that would be awesome. That's what I'm looking for in this trade for that type of short call spread at the top of a move, or a short call in there. All right, so didn't do anything over in my margin account with, or in my IRA. That was only in my margin account with Facebook. All right, so that's about it for today. And the reason why is because it's more of a short term trade that has a lot of risk, so I don't want to really throw that over there in my IRA. That's all I got for you guys today. Thursday's webinar is going to be on the short put butterfly, or sorry, the long put butterfly, broken wing butterfly. Jeez, that's a mouthful. Yes, and it may seem very scary because it's a broken wing butterfly. It's in the advanced options, but I'm going to break this down for you and make it a little bit easier and show you strike locations to increase your probability of success. If you go online, figure out how to do a broken wing butterfly, that's great. And I encourage you to do that, as a matter of fact, so you're kind of ready for this, because I'm going to be teaching you guys things that nobody else is going to be teaching you. Strike location, how to increase your probability of success. How much credit should you receive on this? Should you receive a credit? I mean, it starts out as a debit spread, as a long butterfly. Why wouldn't we pay a debit? Well, I'm going to show you why. Go to protraderstrategies.com and find out, sign up for that. All right? If you can't take that, take it easy.